Good evening, everyone, and welcome to our M&A Masterclass. My name's Mitch Young, co-founder of the Fusion Consulting Group, and we're delighted to be here this evening joining you in what is going to be an action-packed masterclass full of great content. This webinar is brought to you by a Fusion Consulting Group. We are a professional service group essentially built for fast growth entrepreneurs, families, business owners in the UK to provide a joined up approach to their professional services. And where this comes into great practice is when you sell a business. So we have in-house tax advisors, accountants, CFOs, wealth planners and solicitors, all in-house, all providing expert advice round the table in order to provide greater efficiencies for our clients, particularly on any given transaction. Delighted to be joined today by my esteemed colleagues who will all be sharing their wisdom in their specific areas of expertise. So tonight I'm joined by Adam Bloch, who heads up our CFO as a service division, Neil Jacobs, who heads up our financial planning division, and Kush Birdi, who heads up our legal division, who we previously acquired from Birdi & Co. You'll be hearing from all of them very shortly. So the agenda is absolutely packed. And what we've done is we themed it around a case study, which I'll talk to you about in a moment. We'll then be hearing from Adam about the importance of a CFO, financial due diligence, before you sell your business. And then we'll be getting into the meat of it with Kush about locking down the legals. Then you'll be hearing from me on pre and post tax planning, followed by Neil, who will talk about what to do with your wealth once you've sold the business. Our session, we're aiming to hit around 30 minutes, and that will be followed by a Q&A session where you can ask any of us questions about your specific areas or indeed your matters that you'd like. There is a chat bar, chat function as we work through the webinar, so feel free to say hi, and any questions you have you can put on the chat bar or the Q&A box as well, and we'll get to all those questions and comments at the end of today's webinar. Before you ask on the questions, this webinar is being recorded and a copy will be sent round via email to all of you and to those who have registered. We're also delighted to be offering a special offer for those that are attending today. And for those who are, we'll be essentially offering a complimentary 360 meeting with a representative from all our areas. So you can have a meeting combined with the tax advisor, wealth manager, CFO, and a solicitor, just to talk about your matter, whether you're gearing up towards a sale or you'd like to ask us questions within a 20-30 minute quick fire session. So if you'd like to take advantage of that, please do get in touch with us within the next 24 hours, and we'd be delighted to sit with you as a combined session, which is usually worth quite a lot of money. So I'm sure that's really exciting. Okay, so the case study. So this is, I guess, a typical type of situation that we come across. We have a husband and wife who own their business 50-50. They essentially have a B2B SaaS company which has a valuation of £5 million. The deal structure is £3 million up front and £2 million of that of the 5 million being paid in a deferred consideration, which will be linked to the future business performance. The buyers are private equity backed, so a strategic acquirer, and the timeline to get this deal done is essentially 8 months from the preparation to completion. So that's what we're theming today's advice on, and I'm now going to hand over to Adam Bloch to begin the masterclass.
Yeah, thank you very much, Mitch, and it's great to be hanging with my colleagues this evening and presenting to the audience. So really appreciate everybody's time in advance. As Mitch mentioned, my part of the business is our CFO and finance director fractional part-time service, and we mostly find ourselves supporting young companies who have ambitions to grow and sell, established businesses that are looking to sell, but particularly where there is a need for financial and accounting expertise in the business to guide those companies and guide our clients through growth and an eventual transaction. So that is what my part of the business is all about. And I think there are 3 parts of the case study that spring to mind here for my part of the business. And that is the timeline, the 50-50 split in terms of the shareholding, and also the future business performance and how deferred consideration relates to that. But let's just deal with the timeline first, because that's really all about laying the groundwork. In the case study, it says 8 months from initial prep to completion. But in reality, there is an enormous amount of work to do even before you get into preparation and as you go through preparation towards a sale process. So laying the groundwork. And if we just take a little look at that, first of all, the areas that a fractional CFO, a fractional finance director can help. What you own, you really need to have a list of the company's assets, equipment, products, and property, and it needs to be a clear list without anything missing from that. And you do need to have a really clear understanding of how you make money. You need to be able to explain to your potential buyer where your income comes from and what it costs to run the business. And this is a story that a fractional CFO, a part-time finance director, can help you build. Not only that, you need clean records. So when it comes to your paperwork, and I'm sure my colleagues, Kush and Neil and Mitch will appreciate the need for cleanliness in terms of your sales documentation, your expenses, your contracts. And this is because they need to be easy for someone to find and understand. Moreover, a fractional CFO can help you really and truly understand what you owe, and if you do owe anything prior to a sale, how you're going to deal with that. So when it comes to your debts, your loans, or unpaid bills, there needs to be a plan in place, and a buyer needs to know that they are being handled. Your agreements, leases, vendor contracts, customer agreements, and employee paperwork need to be right up to scratch, and they need to be detailed and placed in the right place. The other part of the story that needs to be looked at and prepared is how has the business changed over time, whether it comes to the shift in sales or costs or your staffing. The recent shift in the lead up to any transaction, there needs to be an understanding of how that has changed and what it might look like during the sale and after the sale. And this will also incorporate any challenges that you might have. So you will need to prepare explanations as to what seasonal challenges you might have or what product development challenges you might have that will incur post the sale and forevermore. None of this is insurmountable, but it's all about making sure that there is credibility and viability in terms of your story when you present it to your purchaser, your buyer. So you need to know, they need to know who is essential to your operations and what is essential to your operation, people, systems, relationships, etc. What's going to keep things running as they are once the transaction has taken place, and how is the business going to grow? And this comes to the conclusion of the preparation, which is planning ahead for the questions that you will receive. So all of these items in terms for preparation and laying the groundwork, a fractional CFO or a fractional finance director will be able to support you. And then moving on to pinpointing the value. So what's also interesting in terms of this particular case study is this is a husband and wife outfit, and they each own the business. They equally own the business. And so what is the deal going to be? Or moreover, what is the most acceptable spectrum of deal evaluation pricing that's going to be okay for both of them? The last thing you want to do is to be in a position when you're presenting to buyers and there is a major difference of opinion in terms of the valuation of the business. So a fractional CFO can help with those discussions pre-presentations. And then what is the realistic price of the business? You've got to consider what a buyer might find valuable. It might be that they're placing value on the steady sales or the loyal customers, or maybe the unique products. But ultimately, you've got to find out what is the realistic price of the business. Maybe the fractional CFO can go into the market and do some due diligence and some analysis around what similar businesses are being sold for. Similar research around sales of companies like yours to get rough ideas of what yours is going to be valued at. And also in terms of the deal structure and evaluation, in terms of presenting that to a buyer, the price has got to be based on fact and potential growth and forecasted properly, not just on pure hope. So then there's framing the story, which segues nicely into framing the story. As you go into a sales process, you're going to need, as part of sale documentation, sales presentation, purchase investment memorandum, you're going to need a forecast. You're going to need projections. What is your business doing now, and what will your business do within year 1, year 2, and year 3 going forward? And that's the financial model. That's the financial projection, and it's got to be framed properly. So a fractional CFO can help you pull that together and ensure that it's well presented for your purchaser. Where does all this information go? Well, facts will drive the insight and will give credibility to the valuation and the pricing and the negotiations. And during due diligence, you will need to be preparing a data room where all this documentation that I've been talking about will go in. And that's a place where where documentation is easily accessible, it's well structured, and it's also a place where responses to due diligence is placed. And a fractional CFO can help you put that together. Ultimately, it's about making the deal happen. And in this instance, we've got a husband and wife who've been building this business over many, many years, and they're very emotionally invested in it. And so it's making the deal happen. And as much as they will want to find the highest price possible, the best value for them, to actually make the deal happen and to make it happen smoothly, a fractional CFO, a part-time FD, will play the objective card and make sure that they can push the process through. But all the while, even though they are the linchpin for all the advisors and the business and the purchaser, they will have this husband and wife's backs. They will make sure that they're looking after their pricing. They will make sure that they're looking after their position. So negotiation, always good to have a very experienced commercial finance leader of some sort supporting you during that transaction. So to summarize, what you can probably see here is that the CFO and the finance director becomes really the linchpin of the process and the point of contact for all advisors, and the point of contact for you as a business owner and for the seller. And the last message that I'm going to leave you with is, don't drop the day-to-day business ball whilst selling your company. it is all too easy. There are two major work streams going on in your life once you get into a sale process. One is the day-to-day business and making sure the performance of the business actually is still going well, but also the night job is the selling of the company. And if you drop the ball on the business day-to-day, that might have a significant impact on the credibility of the business and ultimately an impact on the pricing or the structuring of a deal. So hopefully that gives you a bit of a flavor of how a fractional CFO can help you with the financial aspects of an M&A situation. And now I'm going to hand over to my good friend, Kush.
Thanks, Adam. Really clear look on what a kind of the fractional CFO service would look like. Really interesting to hear myself, actually. So hopefully in this whole sale process that you've undergone, you've got your figures lined up. Hopefully you've worked with Adam, and maybe we've had a bit of an intro with him as well. But what I think a lot of business owners or founders do underestimate is the legal process. And I think this is where kind of the real value of the legal advisors do kick in, because ultimately our job is to try and effectively complete the last stage of that sale process into getting it completed. So it's incredibly important to work with advisors who do specialize in selling the business. And, you know, if you're selling your business for, you know, £500,000 or £1 million or £5 million, like our fintech founders, you know, it's incredibly important that you are able to retain that. What we're talking about here is you don't want to fall into the trap of signing documents that, you know, aren't necessarily your interest, or you're not being adequately protected, or just to fall into, you know, later be clawed back by a buyer of either having future payments not being paid, or money clawed back from you because there's some clause in the contract. So, you know, although, you know, everyone does look at the finance aspects and the headline price, etc., and what they're getting at the end of the day, but it's in reality what you keep is incredibly important, and that's where the legal documents are vital. So yeah, I just want to touch a little bit about the role of the legal team. So, you know, there's always this debate about, we get questions asked about whether we just advise on the legal side or whether we actually actively manage the sale process. Now, actually, if you don't know already, it's both of those things. As the legal advisors, our job is to make sure that the transaction can proceed smoothly and actually reach a completion, because from our perspective, a buyer and a seller, which we've got here, like our fintech founders, have reached an agreement in principle on a sale and a purchase, and we want to make sure that that happens safely. So of course our role is to make sure that we're providing with the right legal advice along the way, and that involves being proactive about what we're saying to you and how we're managing that. But, you know, managing the project and the process is a really key part of what the legal advisors do. So just wanted to make sure that you were aware of that. And it's really important that we're able to be proactive and sit down with you and make sure that we know what to do and when, and making sure that's explained to you. So I think in terms of, you know, what to expect during the legal process, there are obviously a number of moving parts to this. And in terms of timelines, our case study sets out an 8-month time frame. Now, in reality, things can take a lot longer than that. You know, people, you know, do start the process of selling their business, you know, years in advance, although the legal process may not start at that time. But I think that the key point here is to make sure that that there's organization, that there's planning involved. And I think that it's not uncommon for legal hiccups to crop up during at least the legal process. And I think that if you're working with different advisors that are part of the same structure, like we are as part of the Fusion Group, really we're going to be able to have an eye on what's going on earlier on in that process before the legal process formally starts. So that's only going to sort of value, you know, it's going to be invaluable to your sale process. In terms of negotiations, our role is vital to making sure that you're protected when you're negotiating with buyers. So in our case study, we've got buyers from private equity who are going to be quite rigid with certain things, and they're going to have a particular type of model that they need to achieve. So, you know, they're going to be asking for you to sign up to various clauses. We've got payments in the future happening here. So we want to make sure that you're negotiating correctly and that you're not signing up to onerous terms that are just favourable one way. And that's where our expertise in the market and across different types of sectors, we're dealing with a fintech business here, but actually, with us, we deal across a wide range of sectors such as healthcare, childcare and education, even fintech, engineering, other types of sectors as well. So we can bring that all together and make sure that you're protected. In terms of the emotional side, I think this part is possibly underestimated. You're trying to run the business. Adam touched upon this slightly. You're trying to run the business. You're trying to perform the business to make sure that it's showing the best possible picture throughout the legal process as well. And you're selling your business. So I think that if you're undergoing a retirement sale, in particular, that could be quite emotional for sellers departing. And so trying to manage that is incredibly difficult. So it's important that you have advisors on your side that can help regulate that and make you feel calm and supported throughout that process. And that's what experienced legal teams will do. So, okay, I just wanted to touch upon briefly, without getting too technical, on the broad process of a business sale. It does vary from every transaction, and there are different variances based on sectors as well. But what does the legal process entail? I think from the legal process begins when you really receive an offer and you've accepted that effectively. So all the negotiation work around price, etc., usually goes on beforehand, and we get introduced once the price has been agreed. So making sure that you're appointing your legal team at that time. Now, if you're working with us, then the likelihood is we'll be involved a lot earlier, because if you're working with Adam or any of the other members of the group beforehand, we're likely to be brought into that for a continuity kind of function a lot earlier. And that's one advantage of working with sort of advisors under one roof, I suppose. But certainly once an offer letter or heads of terms are issued, that's when the legal team should come in, because what you don't want to do is sign any heads of terms, which is your broad skeleton of what the structure of the transaction is or what the terms are, then appoint a legal team for us to kind of pick holes in it or advise you that it's not really working for you in terms of protecting you legally. So get the lawyers involved at that point. We can then make sure that you're not signing up to anything from a broad structuring perspective. So as an example, in our case study, we have £2 million, which is being paid in the future now, and that is linked to the future's business performance. So the questions that we want to ask and negotiate, if they haven't been negotiated already, is what kind of metrics are involved there? Are we talking about profitability? If so, how's profitability measured? Are we talking about pure revenue? We're talking about a mixture of things, and how's that tied up? Or some in types of businesses like fintech or SaaS-based companies, it might be that certain contracts have to be in place and not terminated, or a certain contract has to be renewed as a condition of getting that future payment. These are all things that we need to scrutinize at this point so that the rest of the process can run a lot smoother. And then the due diligence process is when buyers will be sort of asking you to answer lots and lots of questions, produce lots of legal documentation, and they'll be literally scrutinizing what you've done. It's like lifting the bonnet of your car effectively. So the more organized you can be, the better in presenting that information to any buyer. And then I don't want to go into too detail into this process, but obviously the legal paperwork is a key component of the process, and some of the contracts can be quite long. Us as specialist advisors, we're familiar with these documentations, so we understand sort of where to look and what to advise on. Your private equity buyer or any other buyer will be expecting you to sign up to things like warranties and indemnities, which is essentially like statements about the business that you're effectively legally confirming, which could give a buyer rights to come back later if those weren't true, or if there's any skeletons in the closet. So all of these things are running concurrently, really, in terms of the due diligence process, the negotiation of legal paperwork, and it's incredibly important. I can't emphasize enough to work with advisors that know what to do and when and how to negotiate these documents, because like our founders, they don't want to sell their business, get their 3 million, get their 2 million future payments, and then worry about what's going to be happening in the future. And you want to be able to sleep at night, right? So that's really what we can offer. So as we get to preparing for completion of the sale, obviously, you know, when the day comes, it can be incredibly emotional. There's lots to manage, and you know, legal advisor should be experienced enough to get that done for you and ensure that you got your proceeds. So that's broadly the process, and there are lots of obviously moving parts. There are things that I haven't mentioned in here as well, in terms of company structuring. Sometimes there can be like novel structures. If there's any regulatory aspects to a particular transaction, then that also needs to be planned in advance at heads of term stage, to avoid any complications later. Okay, so I hope that that's a decent summary of the legal process. And just finally, I just want to go to that slide, which is just some key takeaways. You know, if there's anything that I want you to remember from what I'm saying here, I just want you to remember some really simple things, which are, so we help you navigate what can be a complex process. Selling in business is complex, and you do need specialist advisors. It's not always easy to use your solicitor that might have advised you on property things in the past, because they may not have dealt with these types of things. And if they haven't, it's a good idea to consider specialist appointment like us. We ensure you're not accepting onerous terms. We want you to sleep at night following the sale. And also, problems do come up in business sales, whether it's negotiation problems or conversations that haven't been had, or due diligence issues. And the real value of the legal teams is trying to find solutions to those problems, and using the experience of selling, you know, hundreds of businesses is we can usually come up with one, which is always useful. And finally, we protect you against clawback of your hard-earned money. Once you've sold, we want you to keep all of that money. You feel safe, and you can then go and do what you would like to do next. And that's all from me. So I'm going to now hand over to my colleague Mitch.
Yeah, thanks, Kush. Really useful insights there. We're getting some great nuggets of information from everyone. So hopefully you're writing down some points that are relevant to you. But if not, you can listen to the recording of this many times. So my section is going to be broken down into 3 slides. We're going to look at pre-tax planning, post-tax planning, and then some other tax treatments on some elements of the sale that you may or may not be aware of. So I guess the main tax that you pay, should be aware of when you're selling the business, you're selling shares, assets in the business, is capital gains tax. And the relief that our clients always look to shelter is called business asset disposal relief. So that is a relief whereby you pay a reduced amount of capital gains tax on the first £1 million that you receive from the as a gain on the sale of the business. Now, we've seen quite a lot of activity last year because the rate of capital gains tax in regards to business asset disposal relief is increasing year on year over the next couple of years. And we're seeing more activity this year because the rate currently is at 14% on the first £1 million. Now, one of the key things that we look to do with our business owners is to ensure that they understand prior to sell the conditions of business asset disposal relief. I'll just whiz through these very quickly. The main ones being you need to be an employee or officer of the company for at least 2 years prior to sell, hold at least 5% of the ordinary capital voting rights. And a big one is, it may seem obvious, but you need to ensure that the company is a trading company, or the holding company is at least a trading company at least 2 years prior to sell. And this is really interesting because you can assume that you have a trading company, you know, it's turning over, like in our couple situation, you know, they've got £5 million worth business. But essentially, if you have things like too much cash in the bank, for argument's sake, let's say that couple had £10 million of cash in the bank, then HMRC could potentially deem that company to be an investment company. And therefore, it would disqualify them from the availability of obtaining business asset disposal relief. So essentially, the general benchmark of sort of the trading versus investment activities test is around the non-trading activities should not exceed 20%. And by reference, they're referring to that of turnover, asset base. So you constantly gearing up to sell, need to be aware of that. Of course, when we're talking about asset base, some of our entrepreneurial clients have invested in real estate. So it's that same type of thing. If you're building up real estate within the business and it suddenly dwarfs your trading activity, then you could potentially fall foul of that and therefore not qualify for business asset disposal relief. So really, as you gear up towards the sale, you want to ensure that you shelter these very valuable tax reliefs, because as we know, in the UK at the moment, the government are clamping down on taxes. Taxes do need to be raised, and that is why selling your business over the last 24-month period and this year could be an exciting opportunity to shelter capital gains rates, not only at the business asset disposal relief, but of course the capital gains tax rates, and they have increased over and above the business asset disposal relief to sort of 24% level. Some of the other things you can consider when we talk about pre-sell is we're talking about business asset disposal relief. That is an individual cap. So each individual has a lifetime cap of the £1 million. So what can be done leading up to a sell, assuming you have the time, is maybe spousal transfer. Again, if you and your spouse qualify and meet the condition like they do in the scenario that we've come across, they both can benefit from 2 lots of £1 million. So the husband will get £1 million business asset disposal relief and the wife will get the business asset disposal relief. Other things you may want to consider is maybe a restructure of shares. So yeah, certainly a lot of our clients are looking at things like group structures, corporate group structures. So instead of owning the shares as individual owners, you own the shares corporately. So you do a share reorganization where you have your holding company owning the shares of the individual. You may lose the availability of business asset disposal relief, but essentially you can potentially qualify for what's called substantial shareholding exemption. That means that when you sell the business, the proceeds, instead of going to you personally, go into your holding company. That transaction, if it meets the conditions, will qualify for substantial shareholding exemption, and there'd be no tax on that. Of course, you'd need to seek tax advice, because if you need to get the money out, there could be a income tax position there. So careful planning needs to be considered as well. Other things to bear in mind, employee ownerships. We're seeing a lot of employee ownerships, and they're not relevant to this, to our scenario, but essentially employee ownerships can be considered, particularly around EMI scheme, which seems to be the most popular. And there is something called an employee ownership trust, which, if you meet the conditions of that, can be very, very exciting from a tax perspective, because you may not have to pay much tax at all if you can meet the conditions of that. But essentially, that's employee ownerships. It needs to be accessible to all employees. There's a couple more points before I move on pre-sale. One of the other things that a lot of our clients are looking at pre-sale is essentially becoming non-UK tax resident, something I'm dealing with every single day. And if you have the time prior to sale to consider this, and obviously a lifestyle meets those conditions, you can potentially look at that. You can become a non-UK resident. You can potentially sell the shares of your UK business. And if you're in a low tax or no tax jurisdiction, then the capital gain that you make on the sale of your business might be exempt from capital gains tax. You need to be aware of the temporary non-UK residency rules, which means you have to stay outside the UK for 5 complete tax years in order for that capital gain not to be brought back into UK tax. So quite a lot to think about prior to the sale. The main one, of course, being the sheltering of business asset disposal relief. Now, of course, what do you do post-sale? And if you haven't done any planning, you do have a large capital gains tax. The billion-dollar question is, how can you mitigate that? How can you plan? How can you plan moving forward to be more tax efficient? Now, the reality is capital gains tax, once that event has happened, it's, of course, very difficult to do anything or come up with anything that can really mitigate that tax. But I'll tell you a couple of things that you possibly could consider, and that is around reinvesting the proceeds into tax efficient vehicles. So these are called EIS and SCIS. From an investment perspective, these are always considered high risk, so it's important you seek independent financial advice before you would consider any of these. But from a tax mechanic perspective, essentially what it means is that you could invest or reinvest the gain into a qualifying EIS, Entrepreneurs Investment Scheme, Enterprise Investment Scheme, which essentially UK growth businesses or indeed funds. And then essentially what happens is that that gain gets deferred as it's reinvested into those EIS shares. And then when you sell those EIS shares, that is essentially when the gain will be taxable. SCIS stands for Seed Enterprise Investment Scheme, and these essentially apply to just early stage seed companies. And what you can do, there's maximums that you can invest into these seed companies, but then 50% of your investment into these seed companies can actually be exempted from tax, not deferred, with the remaining deferred. So this is something that can be considered, but needs the linkage between the tax and financial support. And it's unlikely and probably not recommended that you would invest your full proceeds into one of these products. But then I guess it's talking about what structurally can be done in terms of moving forward. Once you've utilized some of your wealth, which Neil will talk about, you may want to look at a structure that gives you the flexibility and sets your family up into an efficient environment. And we typically look at what's called family investment companies. The way these are sort of set up is essentially, they sound very fancy, but essentially it's a limited company. The parents, so in this scenario, the parents may set the company up via a loan, and then their children and the trust may own the company as well, governed by a shareholding agreement. And then any future growth over and above the ownership percentages of what the children own will sit outside the estate of the parents. They can invest into whatever it is that they like. And then because they've set it up via a loan, any sort of income coming back to the parents can just be repopulated via a loan. So these are very interesting scenarios in the right type of investment strategies, particularly when you have wealth on your side post-still. These are totally approved structures by HMRC as well, and essentially they become very popular alongside the trust. So my final slide, and we'll come back to the couple in a moment, is around the tax treatment of essentially deferred consideration or future earnouts. So this is really interesting. Essentially, when you have a fixed deferred consideration, so that may be not on the business performance, that is going to be taxed up front, essentially taxed at capital gains tax rate. Contingent consideration is where, in like our couple scenario, that will be based on maybe the future EBITDA of the business or the performance-based metrics. And that, again, will be subject to tax, capital gains tax, which I'll come on to in a moment. And that will be payable essentially at the earlier of when it becomes as the figures become available or when it's received. And that's likely going to be subject to capital gains tax. But this is a crucial point. When you are dealing with deferred consideration and when you are dealing with things like earnouts, it's really important from a tax perspective that you get some good contracts and legal drafting in place around this point, because essentially HMRC could come along and potentially challenge that. Oh, actually, you're now working for the company. You're responsible for this. We might tax this as income and not capital. And there's a lot of case law around deferred consideration and whether that relates to employment or not. So typically what we'd advise and what happens is that the sellers of the business, if they're going to continue in the company, they have an employment contract in place which clearly defines what employment duties they're doing, their salary, etc. And the earn-out and the deferred consideration is sheltered within the SPA, which obviously Kush will and has spoken about. The other point in terms of, I guess, deferred consideration earnouts is in and around the loan notes, not necessarily relevant to our client's situation, but you have essentially what's called qualifying corporate bonds and non-qualifying corporate bonds. So typically on a scenario, you'll have an element, some of which is cash, some of which is deferred consideration, some of which may be loan notes. So again, it's important to obviously understand these and the tax treatment around sheltering of those. Qualifying corporate bonds, essentially the gain on the original disposal is frozen and then only taxed when the qualifying corporate bonds, essentially a loan note, is essentially converted. Qualifying corporate bonds are exempt from capital gains tax on further growth, on further gains. And non-qualifying corporate bonds essentially the other way. So in terms of our client situation, just looking at the numbers now, they will have, I think there was a £5 million gain. The first £1 million each, they have to pay tax at 14%. So they will be paid, they will have to pay £140,000, and that will be payable on the 31st of January 2027 via their self-assessment. The next part is contingent, will be taxed at the capital gains tax rate, 24% likely. I mean, if it's in a year or two or three, who knows, that may increase. The rumours are it may increase. So they have another £359,280 to pay. So essentially on the £2.5 million each, they have to pay £499,280. For anyone following can check my calculations. So quite a lot, to get through there, but just some key takeaways. Like Kush, I want to give you a few key takeaways. One, business asset disposal relief. Let's utilize that. Make sure you've sheltered that. Deferred consideration, structure the deferred consideration in a way, working with your lawyer and tax advisor, that makes sense for you and it's going to give you the best return from a tax perspective. Share reorganization. So if you are going to get your spouse involved or you are going to do anything structurally, do that 2 years prior to the sale. And essentially, those are my key considerations for now. So thank you very much. I'm now going to pass the baton over to the final advisor today, and that is Neil.
Thank you, Mitch. So when it comes down to strategic planning before the sale, I would say in regards to one of the areas that a lot of our business owners have within their businesses, because as an advisor, we effectively advise our clients that it's a very cost-effective way of ensuring their family, is relevant life. One thing is important for all business owners to know is that most of the providers allow that product to be transferable. and it should be able to get transferred to a personal policy. So it's useful, obviously, before you sell the business or part of that transaction, that you maneuver some of these policies into your personal name. Away from relevant life, when you are looking to sell your business, there may be some key employees within the business that they are buying into. One thing a lot of our clients beforehand haven't considered is, have they insured that asset? Is that going to have a detrimental impact if they're no longer there for whatever reason before the sale? If that was a person that has such a big impact on revenue or research and design, or, you know, depending on what business you're on. So there are policies available which show a level of maturity as a business owner, that you're ensuring the key people in your business. You've got the rights, I guess you'd call it the right foundations for building the business up. And once it is built, those foundations stay there. So if there are any sort of events that occur, you know that you may have the funding to pivot to ensure that it doesn't jeopardize the running of your business. Pensions is another key area that we're always speaking to clients about when they're running their own businesses, just like the case study here. And although all of us want to sell our business for millions, we're not always sure what number we're going to get to. So I would say, as a business owner, the most important thing is to do things in a sustainable manner. So don't leave it to the final hour. Build up your pension over time in a sustainable way, rather than leaving it to the year before sale, seeing that you've built up loads of profit in the business and try and aggressively pull it out. It's far more efficient to do it over time. Start off small as the business is growing and you're obviously reinvesting in. And as the business develops and matures, then obviously you can be more aggressive with those contributions, because effectively, as long as it's sustainable and the accountant's comfortable with the number that's being contributed and you're doing it within the allowances, it should be fine. So I would say that's a very important area to consider. Build it up over time. Don't leave it to the final hour. And a lot of our clients that we work with have also gone into collaboration with their fellow directors and considered using, for example, a CFOaaS to invest in commercial properties. It allows them to benefit from another asset, investable, that they can use the money that's held within their pension to invest in, and it keeps it from away from the business. It's not owned by the business. Exactly what Mitch was saying before. If you're going to invest in properties and you want to benefit from all these tax breaks that are still available, you want to keep it away from the business, whether that's a different holding company or using your CFOaaS, self-invested pension, maybe, if you're doing it as an individual, as a way of investing in some other commercial properties. Things you need to really consider when just before the sale is making sure that, for example, with the pensions and your employees, that everything's documented. If there's agreements on bonuses and the contributions being made to a pension, if someone's hit a certain number, like, in order to keep the energy in the business, the right ethos working throughout the team, everything needs to be documented, contracted, so the person who's buying the business knows what they're in for. And secondly, the employees on the other side know that they're still going to be getting everything that was agreed. So it's always important to make sure that all the employee contracts are updated, that they fully include all the pension contributions that the employee is expecting. It's also really important when you've set up these type of policies, you make sure that all the trusts have been set up to go alongside them. that can be easily done. You just need to speak to your financial advisor. It's also, like I said before, easy to transfer these type of policies outside. At the end of the day, everyone who's selling their business wants to really maximize the amount they're going to receive. So being able to illustrate everything's organized, everything's documented, that everything you've done in terms of being able to efficiently extract money from the business into your own pensions or using other tax efficient ways is done in a sustainable way rather than at the final hour, which could impact you a bit, which may not help you on the sale value, but that's more for Kush's area than me. So there are some red flags you need to consider. That's something we'd look at when we're looking at what sort of benefits you've already got in the company, what sort of benefits you're trying to provide yourself. But I would say one thing to take out of this, whether you're on that journey or not, is start early, make it sustainable, put in the right foundations, make those contributions, however small. And then by the time you're at that point when the business is worth 5 million, you're probably making quite generous contributions at that point into your pension. But it doesn't neglect the fact those contributions you made earlier on still have a massive value due to that compounding. So not only are you selling your business for 5 million, you've also probably built up a very healthy pension pot away from that, which has come from profits from your business over so many years. When it comes to your post-merger advice, the important thing for me when I sit down with clients is how can we make things tax efficient for the future, but also help you out with certain capital gains taxes you're going to be faced with. So we've already touched upon it, but a big area for that would be enterprise investment schemes with that 30% break. Obviously, that would defer the capital gains tax, but there's other things people want to consider when they've been working so hard in their business, maybe lost some of that time with their family because they were building a business over time and put their heart and soul into it. There's inheritance tax. Suddenly now they've got this massive asset sitting in the bank. So how can I reduce my inheritance tax? That's another thing they may want to be really incorporating into their strategies. But then suddenly I've sold my business. The dividends have stopped. So what else do I need to consider? Where's my income coming from? How am I going to get income? Now, a lot of you say, well, he's got 5 million in the bank. He'll be okay. But the reality is you want to do things in a sustainable way. So there are investments that you can put into place that will give you tax deferred income, where you could take 5% a year and pay no tax on that each year and defer it for over 20 years. That will help a client in regards to making sure that they've got a good, steady income coming in from part of their investment. They'll use EIS investments or CDIS to defer their capital gains tax. And obviously, if they keep them in place all the way until death, that you could even lose that capital gains. And obviously, then you've got the IHT side of things to consider. Then you've got the business relief investments, where by incorporating that within the strategy, you're also helping reduce your inheritance tax. Now, this business that we're looking at as a case study has 2 owners. So when we talk about the reliefs you have, obviously the 5 million, 2.5 each, let's say, they're going to double up on these sort of contributions. So they're really maximizing their allowances. So definitely an important thing to consider. But before we do all of that, the most important thing in terms of financial planning, I would say these days, is just utilizing cash flow forecasting. Where am I going to get the income from? What tax am I going to pay? So what is the net income? before we do that, we'd be looking at the client's expenditure post-sale. What is your lifestyle? What are you going to be spending month to month, year to year? And how are we going to derive that income? And how much do you need to derive that income? And then that will also allow Mitch to look at what's left and see, well, can we use some of the gifting 7-year rules for some of this money or not? If there isn't, then it may be utilising the BR investments or trusts. It really depends on the sort of flexibility a client needs with their investments. Some people want to still have control, and that's something that Mitch or myself would always consider. Once you've moved away from the business, there may be certain benefits that you had from the company that you've lost, such as private healthcare and the pension contributions that were being made. So is that something you're going to have within your negotiations when you're becoming an employee? If you're not becoming an employee, it's less of a concern. You just need to set up certain private health plans in a private way, unless you're looking to start up another company, and then you can do it through there. So the key takeout of this is you really want to look at the big picture. Most people are going to be considering, how can I reduce my capital gains tax I'm going to pay? I'm suddenly now really far into the 40% tax on IHT and losing some of the allowances. So how can I really make use of certain investments that we've touched upon? And then putting that all into an overall strategy, but not forgetting the fundamental that I want to live. I've just sold a business for £5 million and I want to enjoy myself before maybe I start up my next venture. So cash flow forecasting will definitely help us work out the sustainable income, how long it can last, and also stress test it. So really important for our clients who are selling their business to also see post-business sale how things are going to look and how they can be put in place, working in conjunction with my tax team run by Mitch.
Great, thanks, Neil. I see we've got loads of questions, so we're running over. So hopefully, I can see most people have stayed on, which is really great, and loads of information there. So always tricky with 4 of us on the call, but hopefully you've got loads of information. So we're just going to dive straight into questions. If you do have any more questions, please do put them on. We've seen a lot of questions about valuations, what valuation methods are being used. We've seen a lot of questions about tax rates and the tax changes. And then we've got one question about a particular case study. So if we just cover those 3 areas really quickly. So first one at the start of it, evaluation. I guess, Adam, do you want to just touch upon how we're seeing business being valued at the moment, and what type of method you're seeing in practice?
Yeah, I think it really does depend on what industry your business is in. In this, for example, this particular case study, we're looking at a software company. It's a SaaS business, and it's most likely that this kind of business is going to be valued on a multiple of EBITDA. In the software industry, that's pretty standard. Within the SaaS environment, which again relates to this case study, you are seeing certainly at least 10 times multiples and possibly more, depending on the specific tech-enabled SaaS software that you're involved with. But more importantly, I think it's where does the valuation, where do evaluations come from? And it, as I said, it goes back to the research in the marketplace. Professional services. There's a lot of talk around valuations of a multiple of revenue. People will look at ratios in relation to revenue per head, There's a whole bunch of different ratios that need to be looked at when it comes to evaluation. So I guess, as I reiterate, that one of the items that a fractional CFO or fractional finance director can take a look at is some deep analysis into your industry and some benchmarks as to what will make sense, for evaluation.
Okay, thanks, Adam. Really good, good questions there. We've got a lot of questions about the tax changes coming in after April, so I'll just quickly go through that. The big tax change on the business asset disposal relief is increasing from 14% to 18%. We'll just do two more before we cut off for today. So let's do one for Kush. Should a lawyer draft the heads of terms?
The short answer is yes. That would be my advice, because we can really make sure that we're covering the nuances of the particular transaction at hand. So definitely.
Yeah, it's a good quick answer, which is why I asked the question. Okay, good. And then we've got a great question here from someone that's listening. So I'll try and keep this brief. Anyone else chip in as they like. I'd like to purchase my mother's business, of which I'm an employee. Acquiring a business through shares, is that the best way? Is there a straightforward plan? I'll eventually create a holding company for my other businesses, if that could come in handy. So if anyone wants to chip in on this, by all means. But essentially, yes, I mean, there's lots of options. Obviously, we need to know what sort of trading business your mother is doing, whether it's a trading business or not, whether she can qualify for business asset disposal relief. I think from your perspective, a group structure in terms of a holding company could be exciting from your perspective, and getting those monies into your holding company, doing clever things within that, maybe doing that because it's your mother's business. You could do something within that 2-year time period and go for some type of share for share exchange or gifting or partial sale prior to that to get that into the group. So maybe that's not the most straightforward plan, but those are a few things to consider, as well as maybe some monies in the company to purchase the shares as well. So there's a few things from my perspective. Anyone else got any nuggets on that query?
I think, well, I've just seen a follow-up saying it's a cleaning business, so that's quite useful. I mean, purchasing the shares, I mean, it could be the best way to go. It depends on multiple things, I would say. Mainly, well, tax, of course, but also depends on what's inside that. So I think also it depends how long it's been run for. But it's your mother's business, so you're probably going to know, I assume, quite a lot about it already. Because, of course, buying the shares means that you're taking everything, all the liabilities, etc., with it. So probably, I mean, more than happy to have a discussion about it. But working with all the different advisors from the different aspects, law, tax, etc., there may be different answers from the different advisors, but working together to put forward a suitable solution is the best way.
Absolutely. And we've obviously gone slightly over 3 minutes over today. So anyone that did post questions, we've received tremendous amount of questions today. We'll make sure we follow up in our own time and get you those answers. I'd like to obviously thank you for your time. A very heavy but hopefully beneficial session. You can see the depth of information and the expertise that you need when you're selling your business, and we're blessed to have that all in-house within Fusion. So for those on the webinar, if you want to take advantage of a free initial complimentary meeting with our colleagues, all sitting around the table, giving you some general tips and advice about your potential strategy to sell a business, then get in touch with us within the next 24 hours. You can see some of our details on screen now in terms of our email addresses. You would have received the marketing as well. So please reach out in any shape or form of communication that you'd like. Appreciate your time on a Monday evening, a good hour session. I'd like to thank my colleagues for their time and their expertise, and Keep in touch with us via all our media channels, because we do pride ourselves on delivering educational based material. So whether that's via our social media or future webinars, we'll be back in touch with some great insights for you. Today we spoke about sell side. We may do another webinar in the near future about buy side as well. So from all of us here, Fusion Consulting, wish you a good evening. Thank you very much.